This is Rod Kusin and Spooman for Risk for Wednesday, November 17th, 2010, all times on the chart, Central Standard Time. Our discussion today will talk about our retracements and a bit about the trend settings. On the chart that you see here, our retracements are based upon the use of the premium, and we have very specific settings that the premium looks for to establish our very high probability retracements. Nevertheless, from this point into the high at 932, retracements were conspicuously absent. We run simultaneous to this a slightly different form of determining retracements that are based upon the VIX. And as we looked at the VIX, we got a different picture. Now here's what showed up via the VIX. The VIX indicated that we had retracements way down at 1173.50, then again at 76.50, 76.75, and again here. So now that gives us quite a different picture as to what we might expect, because these retracements are equally high probability retracements. In fact, as you look at the day with regard to the VIX, you'll notice that with the exception of these three retracements, everything else was filled. 93% probability on these retracements. So unlike the premium, the VIX retracements indicated a drop was forthcoming. Now, that makes it rather interesting as you looked at the pattern for the day. Now, we're going to just touch on pattern for a moment here. We have not had one of these patterns lately. This is what we refer to as a blue day. A blue day is characterized by both the high and the low of the day occurring in the same half of the day. It either occurs in the morning prior to noon or in the afternoon prior to the close. So here's the high, here's the low, and from there the market went relatively sideways. Drop down, did not hit a new low, nor did it hit a new high. This is a blue day. Very volatile, but very fun to trade. Why? Because our retracement lines are so predictable. Now here's the retracements based upon the premium. Again, we start tracking at the open, and that's what we find through the course of the day. Only three left. Now, how can this be useful to the trader? It can be enormously useful to the trader. For example, now without using the combination of the VIX, if we just looked at this run up here, okay, run up to the high of the day, you had a retracement below the market. Now think about this. You've got essentially a 90% probability that the market is going to drop back down to this retracement level. So as the market is running up, all we need to do is to find evidence for taking a short trade. You've got a 90% probability that the market's going to move back down to at least that level. My goodness, think of the possibilities. You just load up a bunch of contracts. You don't have to worry too much about your stops. Why? Because you got a 90% probability it's going to drop. The market does. It comes down somewhere into here, and there's this retracement line up here. Okay, so you go in there and maybe let's account for the fact that we've got a retracement line down here. And now we have to say, all right, we've got a retracement down here. We got a high probability retracement up here. We need to go long somewhere below this line. 90% probability it's going back. My goodness, I'd load up on the contracts. And then when you get into this volatile period in here, this was a little bit more tricky. Because if you started tracking right in here, and let me blow this up a bit. All right, so the market is running up here. So you're looking for a nice move back up to that retracement line, and it succeeds. Once it does, now you have to make another decision. Are you going to short this move because you've got a retracement line down here? Well, depending upon when you make that decision, if you make the decision after this retracement forms here, your risk of succeeding is not as great. It may not go back down. In fact, it may go back up and hit that line and maybe even continue. So trading right in here is a little bit more speculative. But once the trade comes down, takes out this lower retracement line, now it's a bit easier to anticipate what will happen. But what you didn't know is that there was going to be a drop. Now, what could have told you that there was going to be a drop? We'll talk about that in a minute. But the fact remains that that information was available and useful because there was a high probability the market was going to return and take out these retracement points. So somewhere in here, you want to be going long because you have a very high probability the market will go back up and exceed these lines, or at least equal the retracement lines. That is incredibly powerful information. Now, once that succeeds, all right, you didn't have much to work with, at least not with regard to the premium. But for example, in here, once you've got the retracement lines, scalping would be an easy thing to do. You come down here, this retracement line exists. So as the move up takes place, you might be looking to short it. But once you do, another retracement line forms. So even if you shorted it here and it comes back down, you get out of the trade because you know the probability is it's going back up. It does. So a real safe approach would be wait until one of these lines is completed. Okay, so taking a long trade in here, high probability it's going back up. Now once that's over, you don't have much to work with until in here. Now the market moves up, leaves a footprint, says I'm coming back down. You look for an opportunity to short. Your stop is not as critical because you've got a 90% probability that the market's coming back down. Powerful. You can make a living with these retracement lines. Now, this move, that's a bit different. Where's it going? You don't really know. It looks like it's going back up, but enter the VIX. The VIX says, this is where I'm going. So although we have retracements up here, we also have the VIX telling us we're coming back down. So now keep in mind, this is about a little after 2 o'clock. right in there. So having moved down to that spot at 2 o'clock, the probability it was going to continue to go down now was a bit less. Now taking a long trade in here, well, you've got at least these fairly close retracements. But what you didn't know is whether or not it was going to move down to 74. Other than the fact that the VIX, once again, said, yeah, I've got a retracement down here. So the combination of these two pieces of information could have been very, very useful in determining how to trade, in what direction to trade, and with what probability those trades would succeed. Knowing what direction to trade, knowing the probability of success before you even take the trade. Think of that. That is powerful information. All right, let's take a look at a few trades. Okay, let's talk about some of the strategy trades now. We bear in mind, at this particular moment, at 9:07, we don't have any retracement lines below the market. So that's a little risky. However, when we looked at the VIX, we have these retracement lines down here, and the nearest of which is right down here at 1178.75. So as we move up here, if we're using the VIX, we've got the VIX as a potential goal. Nevertheless, the market continued to move up. Now, we had some warning signals about these trades showing up here. Let's now move up to this point here, and we have a series of trades. Of course, we're running multiple strategies with slightly different settings in this workspace, and the nearest retracement line is down here. So now we have a very strong probability that these are going to get hit. They do, that is, the trades make it to the retracement line, and then down in here, right after 9:30, we had another series of trades that also makes it to their profit target, or at least the retracement line. That was nice. That was pretty. Now, you remember this pattern that we talked about here. We didn't have any long trades using the divergence setting, but we did get a short trade up here right before 11 o'clock. That succeeds at its profit target. Now let's take a look at an example of the first long trades that we had today. They occurred right here. This again is the divergence strategy. And we've got these retracements up here. Now, the move down is really no more than about a point and a half. Okay, about 6 ticks down. We had some warning signals in here. Now, normally we've talked about, you know, if you're in a position where you have a warning signal at the time where you've already gotten a loss, it might be a better idea to just dump the trade. Now, that still may be true. But the other side to the equation, though, is these high probability retracements. So, I would contend that it's still always safer to get out of a trade that's already losing and just look for another opportunity to enter, because you don't know how far down this is going to move.